All right, let's jump right into this explainer and objectively evaluate the Axis Large Cap Fund. If you're a conservative investor trying to figure out exactly how this fund fits into your portfolio today, well, you are in the right place. We're going to strictly stick to the data, the historical context, and the underlying mechanics to give you a crystal clear, completely unbiased picture.
To start, we've got to ask the big question that's literally on everyone's mind right now. For years, this fund enjoyed massive historical success as a top quartile performer. But following some recent market turbulence, a broad shift in investment styles, and internal rebuilding at the asset management company, a lot of folks are wondering, is this still the defensive anchor it used to be?
Here is our roadmap for today. We'll start with historical performance and growth, move on to recent volatility and peers, and look at large versus mid-cap benchmarks. Then we'll dive into market cap and risk, decode key risk metrics, and finally touch on planning long-term wealth. Okay, let's kick things off with Section 1, Historical Performance and Growth. Look at this number right here, over 28,000 crore rupees in assets under management as of early 2026. That is just a massive scale. It vividly illustrates the profound trust retail investors have placed in this fund since it launched back in 2010. It truly is one of the largest active large-cap strategies in the entire Indian mutual fund industry. And, that trust wasn't built on nothing. Just look at these historical returns. Since inception, the fund has delivered roughly 13.52%, with a rock-solid 10-year annualized return of 11.90%, and a 5 years sitting between 8 and 9.30%. This clearly demonstrates how their core strategy, which is a high-conviction, bottoms-up approach to picking sustainable growth companies, has historically rewarded long-term investors. Basically, they're hunting for businesses with strong return on equity and proven scalable models. But, as we know, the market is always shifting. That brings us to Section 2, Recent Volatility and Peers. Time to address the elephant in the room, recent market volatility. Looking at the one-year returns, the data shows a noticeable dip. The fund saw a negative 1.85% return compared to a category average of positive 1.53%. Now, the absolute crucial point here is understanding why. The data shows this stems directly from the fund's strict growth strategy lagging during a recent post-COVID market phase that heavily favored value stocks. When the market shifted, Axis stuck to its guns and its growth philosophy, which caused this short-term drag. Now, if we do a clean, side-by-side pure comparison over a specific recent one-year tracking snapshot, you can see exactly where Axis currently sits, up against heavyweights like ICICI Prudential at 0.94% and SBI Large Cap at 3.53%. Axis is navigating a highly competitive landscape. So no, it's not at the very top right now, but it's holding its ground in a market environment that frankly hasn't favored its specific growth style. Context is absolutely everything when we evaluate these numbers. Let's move to Section 3, Large V's Mid-Cap Benchmarks. It is so important that we're comparing apples to apples here. Axis is a pure large-cap fund, mandated to invest in the top 100 companies. Contrast that with something like the nifty Large Mid-Cap Benchmark, which blends 250 companies, and you see a totally different risk profile. That broader benchmark offers higher growth potential because of those mid-caps, sure, but it comes with way higher volatility. This really highlights the key advantage of Axis's pure large-cap approach. It's designed to offer much stronger downside protection during sudden market corrections. Let's dig into exactly how they manage that in Section 4, Market Cap and Risk. Looking under the hood, this fund does exactly what it says on the tin. A whopping 88.8% of capital is dedicated to established large-cap companies. There is virtually no mid-cap exposure here, just 0.2%. The remaining 9.1% is sitting in debt and cash for liquidity. This massive large-cap allocation acts as a heavy stabilizing anchor. We're talking about companies with proven track records and strong balance sheets that don't just easily blow over when economic headwinds pick up. But hey, let's keep our feet on the ground here. As the official source document proves right here on the riskometer, all equity funds carry inherent market risk. Despite being anchored in stable, large companies, the fund is officially labeled as very high risk by SEBI standards. Basically, if the broader market takes a dive, this fund will still feel it, even if it falls a bit less than the others. So, how do we actually measure that risk? Let's break it down in Section 5, Decoding Key Risk Metrics. Let's bust some jargon, starting with standard deviation, which is currently sitting at 13.51 for this fund. Think of this metric as a measure of how much the fund's returns bounce around its average. The category average is actually higher, at 14.89%.
Because Axes maintains a lower standard deviation, it's mathematically engineered to give you a significantly less bumpy ride than your average fund in this space. Next up is beta, clocking in at around 0.90 to 0.91. Beta measures sensitivity to the broader market. A beta of exactly 1.0 means the fund moves perfectly in sync with the market. Think of a 0.90 beta like your car's suspension system. When the broader market hits a massive pothole and drops 10%, this fund is built to feel about 10% less of that impact. It is literally built for defense. And then we have alpha, which is currently at a negative 0.66. Alpha measures the excess return a fund generates compared to what was expected based on the risk it took. Now, what does a negative alpha actually mean for your wallet? It just reflects the recent underperformance we discussed earlier. Because the broader market shifted so strongly toward value investing and Axis completely stuck to its growth philosophy, it just hasn't generated that excess expectation-beating return over the specific recent cycle.
Let's tie the whole shebang together in Section 6, Planning Long-Term Wealth.
Notice how the fund actually structures its portfolio internally. It uses a very deliberate 60-40 split. 60% of the capital goes to market leaders. These are the absolute giants with dominant market share, pricing power, and rock-solid stability. The other 40% goes to emerging challengers. These are companies actively gaining market share to offer that necessary upside potential. It's a really carefully calibrated balance.
But here's the catch. This balance requires serious patience. Look at this historical multiplier data. In year one, you might face negative short-term volatility, kind of like what we've seen recently. By year 3, a systematic investment plan, say investing 4.6 lakhs, historically grows to roughly 5.1 lakhs, which is about a 5.91% annualized return. But it's really in years 5 through 10 and beyond where you see the historical smoothing of returns and the true magic of compound growth. This data clearly shows why you absolutely need a long-term timeline to smooth out those inevitable market bumps.
And this really hits the nail on the head. As the sources note, large cap funds serve as the stable foundation of an equity portfolio. This fund is a defensive anchor, for sure, not a get-rich-quick scheme. It's designed specifically for investors who are looking 5, 7, or even 10 years down the line.
So, I want to leave you with this final thought to chew on. Based on everything we've looked at today, the lower volatility, the massive large cap allocation, the defensive beta, you really have to ask yourself, is your portfolio built to chase the next explosive rally, or is it built to survive the next market crash? Understanding your own wealth planning and risk appetite is the very first step to making these metrics work for you. Thanks for joining me for this explainer. I'll see you next time.